We are live. In today's presentation, we're going to cover how to get rich in 2022 investing. We're urging investors to buy these 4 stocks now before it's too late. Pick one is a play that natural gas prices will go higher and higher and higher as long as there's a conflict in Europe. And bad news is, unfortunately, the conflict looks like it's about to escalate in the coming weeks. Pick 2 is a play that interest rates are about to collapse due to a monumental fall in GDP from China going into an extreme lockdown. 45% of China is currently in lockdown, and this is totally messing up supply chains. Pick 3 made a 20,000% return in its first 5 years and will easily go up another 400% in the next 3 years. Finally, pick 4 protects your account against a stock market crash and made a 1,000% gain in 2020. The last time the world went into a lockdown is when this had this epic return of 1,000% in less than 4 weeks. Do yourself a favor and put as much money as possible into these 4 stocks before you miss out on massive profits in the weeks ahead. Now, Mr. Putin's goal is to crash the global bond market and dethrone the dollar. And they're in cahoots with China. So far, it's working. We've been playing this very well in our portfolio. On April 6th, we sold 1/2 of our Boyle natural gas position for a 139% profit. We're getting ready to sell 1/2 of the new position for a 271% gain. So far, our top selling advisory service is up 47% year to date for 2022. The high risk growth portfolio is now up 233% total return in 2021. And again, we're adding another 40% total return in 2022. This means last year, every $10,000 turned into $33,000. Now, here's the bad news. The European conflict is likely to get much, much worse. One of the flagship Russian fleet was tanked, and now they're responding with much more aggressive missiles into to Ukraine. So unfortunately, there is no signs of relief in the war. Putin is estimating he will declare victory in May. So we're going to be careful about the commodity plays we're in and start taking profits as we approach this point in time. So right now we're going to review a $10,000 trade alert recommendation and exactly how you would do it. So step 1, buy 63 shares of Uvxy. This is your stock crash insurance. And again, last time we had lockdowns, which we're now seeing out of China. It's very questionable why. 2 years later, they're going into extreme lockdown. But they are, and this play made a 1,100% return in only 4 weeks when the S&P 500 fell 34%. Here's the Uvxy chart this year. It doubled and crashed right back down. It did its job to protect our portfolio in the first few months during the sell-off, and we continue to hold a Uvxy position just in case. Step 2, buy 134 shares of TMF. This is the leveraged bond play. And our bet is interest rates are going to fall and make TMF go up. We're at critical levels that will crash everything around it. It's extremely unlikely that interest rates rise from here. So this is a new position we put on, and we may very well double down on this play. We bet on Boyle when it was cheap, and now it's up 271%. Now we're betting interest rates are going to fall and just getting ready to move money from the inflation side into the deflation side with TMF. Here's a look at the return of bonds since 1977, and you can see they almost always go up in value. We're not worried about the interest rate they pay. We're worried about the value of the bond appreciating. And so this is one of the worst crashes in bond history. In fact, it is the worst. bonds have been down 609 days, and now that's up another week. And its decline is now at 15%. This chart's a little, didn't catch last week's big dip. So we are really at critical levels. Here's a look at the TLT percent decline, and you can see it's just a astronomical crash in the bond market. Now, I do believe this was the primary goal of the invasion into Ukraine, is to skyrocket inflation. I believe China is also trying to create this inflation pressure with its lockdown, and so far they're winning. But the good news for bond bulls, which we are now finally in that camp after being out since March of 2020, is that it's extremely unlikely these interest rates will go any higher. If the conflict is fixed, energy costs come down, yields fall. If there's any more pressure in bonds, they will take out every asset class around them and also end up with lower yields. So we're very bullish on bonds after being out for 2 years. Now, if interest rates are going to fall and supply chains start to fix and commodity prices go down, which I think is likely, we're going to expect technology companies to skyrocket. They've been crashing since December, and our favorite tech is a cryptocurrency called Ethereum, ETHE. It's a lot like Microsoft in that it's an operating system, but it's only 5 years old, and it's going to take several decades to hit peak maturity. So we're very bullish in this asset class. If you bought 5 years ago, you're up 20,000%. I'm expecting at least a 400% return in the next 3 years with this very, very crucial cryptocurrency that's revolutionizing the financial system. Now, the easy way to play this in your stock account is with ETHE, the Grayscale Trust. This way you don't have to screw around with companies like Coinbase and worry about getting hacked. You're in your federally insured stock trading account. Step 4. Unfortunately, we're still holding on to BOIL. This is bad news for civilization. We're seeing people starving all over the world. Energy costs are skyrocketing. This is a big problem. So we don't take pleasure in having massive profits in such an inflationary asset that hurts literally billions of people worldwide. But unfortunately, I do think natural gas is still going higher from here. And we're recommending you pick up 35 shares of BOIL. Here's that chart. This is about exactly when we switched from being long oil with NRGU to BOIL. And it took a little while to take off, but boy, oh boy, has it taken off. And it is skyrocketing. 2 things could happen to make BOIL go up many, many multitudes higher than it is right now. Mainly, Putin could cut off natural gas to Germany, and it's lights out for Europe. This could be used as a war tactic. Or Europe may try to stop buying all energy products from Russia to try to force him to go broke and stop the war. So unless there's diplomacy, which again, neither side seems interested in, most likely BOIL is still going dramatically higher in the short term. Now, if we look at this asset allocation breakdown, we have 63 shares of our crash insurance sitting at 8.4% of the portfolio. That's going to go up and down. We're only worried about having the right ratio of shares. So 63 shares of Uvxy is the current recommendation for your crash insurance. We have 134 shares of TMF. That's betting that interest rates are too high. They will go lower. In almost all scenarios, I see interest rates falling from here. The only way debt continues to grow is if interest rates go lower and lower over time. So this is the peak interest rate that we believe is possible without starting to crash markets all around it. So get ready to potentially add to TMF in the near future. Next play on the growth side is Ethereum. We have watched this grow faster than the internet. It is funding all sorts of very beautiful ecosystems. Aave is a huge success story. There's $30 billion of collateral at Aave creating loans. Uniswap is the competitor to Coinbase, the single most used decentralized exchange. This also powered the NFT mania. And it's also just a massive, massive growth opportunity. So right now we have 158 shares of ETHE. And then finally, our inflation hedge, which has been generating the bulk of the profits so far this year, 35 shares of BOIL. Now, I am anticipating we will take half of those off the table this week and rotate it into one of three potential plays. So it's important to note the bond market's now on the verge of crashing the stock market. If we look at interest rates rising to these levels, you can go find just about every fiasco in the stock market over the last 40 years. So it's very important that these interest rates go down in the near term, and one of our favorite plays for the remainder of the year. TLT is the non-leveraged version of TMF. And what I want you to note is that it's at a critical level at 120. If it goes any lower than this, it's most likely going to start eating up other assets and causing massive volatility in stocks. Here's another look at the bond market. You can see that 2-year bond is at this extreme height that we've last seen in 2018, before, once again, interest rates created all sorts of crashes. First Bitcoin, then emerging markets, then the US NASDAQ. They called it the Christmas Massacre, and it forced the Fed to go back into easing. So this is the main message for investors right now. Yields and energy prices cannot remain at this level. We're on the verge of pulling back our commodity plays and betting on interest rates going down and energy costs crashing. And again, most likely the catalyst will be diplomacy. Now, the second the conflict ends, we like two plays. First of all, we know we like Ethereum. We already have that position in play. The new positions I'm interested in are F&GU primarily. This is leveraged tech stocks, 12 of the hottest tech companies that get the most call option volume, and they include 2 of the most beat up tech companies in the world out of China. Here's a look at that chart, trading at 1676. F&GU can scream to new highs if, again, we fix the energy problems and we get the supply chains fixed out of China. So I'm carefully monitoring that. If that's not going to happen, I prefer adding to the bonds. The other play I'm interested in is silver. Silver is a good stagflation play. And with China doing a zero policy with the COVID, we could very well end up in a stagflation period, which had massive returns for silver in the last run-ups in 2008 and 9, as well as in 2017 and 2018. Now, the other big macro feature of the markets is that the US is going into a tightening cycle while China is pumping out credit. And the last time this occurred, Bitcoin returned 4,400%. So just an epic return in Bitcoin. And that's exactly what we're facing now. The US is planning a 2-year interest rate hike cycle, while China is aggressively printing money to bail out its markets. So it's critical you watch our webinar every Monday, Wednesday, Friday to be ready for sell alerts. If you don't want to miss the trade alert, call Dean now at 505-322-7515. Okay, very good. I'm going to look at our returns. So our product has 2 programs. We have the Safe Growth, which is a global stock portfolio where we play European, Asian, and North American stocks. We have multiple types of energy hedges, and it's really designed for the bulk of your portfolio. Returned 25% in 2019. 2020, we underperformed at 4%. We were playing it safe. There was a lot of uncertainties. We didn't know how bad the virus was going to really be. Turned out it wasn't that bad at all. And it was unclear how effective $4 trillion of stimulus would be, but we still had a nice gain. And there was also the election uncertainty. So that's why we underperformed 2020. 2021, we made a great 25% return. And in 2022, we are outperforming the NASDAQ and the S&P 500, only down 1.9%. in April up 1.2. So this is designed to put 70% of your portfolio. 30% should be placed into our high risk strategy, which is now up 47% year to date with a 233% return in 2021. Now in 2020, this product only launched in December. If you do the 70-30 combo, you made a 97% return in 2021, and you're already up 15% total return in 2022. Now, a lot of our clients are just going all in on high risk, and that's fine. But for those of you with 500,000, $1 million, we highly recommend the split. Play it safe and don't put all your money in our high risk strategy just because it has such phenomenal returns. Okay, now we're going to look at a lot of data and our news feed where I retweet the most important pieces of news. And so we're entering a new stage of the conflict in Europe. Everything is escalating. I see no signs of peace anytime soon. So unless Ukraine throws up the white flag, I don't see anything positive happening on this front, at least in the next few weeks. Here's a look at the demand for natural gas relative to supply, and especially what happens if they take Russia offline. So you can see this is a massive, massive problem that's going to last for a decade. And just in general, there's not enough energy to fuel the world. This was just an interesting chart looking at the cost of a gigabyte of mobile data. In India, it's 9 cents, Israel, 11 cents, $8 in the United States. Jim Bianco has a chart showing you just how extreme this bond market crash is. And in general, we've never seen anything like this in history. So just one of the most mind-boggling bond market crashes in history. More headlines about the conflict in Europe, escalating, unfortunately. Lance Roberts shows investor sentiment that is a extreme low. This is due to the inflation and wages not keeping up at extreme levels. U.S. natural gas futures hit $8 for the first time since 2008. Those LNG deliveries to Europe will be very popular soon. Now, gas is trading much higher in Europe, so there's still a lot of room for this to go higher. We're seeing, again, just a big pickup in the war. There's absolutely no reason to think that is coming to an end anytime soon. Here's a funny clip of some electric bus that blew up just for entertainment purposes. Here's the 10-year yield trend, and you can see since the 80s, interest rates have been going lower and lower over time. We're at a critical level. The rate of change is the most extreme in 4 decades. And mainly what you need to know about this is for debt to grow, interest rates go lower over time. And if the debt doesn't continue to grow globally, the entire financial system will implode. Now, a lot of people are expecting the peak inflation to have been the March print, and I am in that camp. Much of the surprise to the upside on the latest CPI was from used car prices falling in February, but they're picking back in March, and now they're picking back up rapidly. And again, this is likely due to chip shortages, which are going to get worse and worse the longer the conflict in Europe goes on. And that's because some key ingredients to producing chips are being disrupted from this conflict. So the longer the war goes on, the stickier this inflation is going to last. Let's see, Charlie Munger dumps his Alibaba. New headline today. We'll take a look at that chart. Rick Ryder from BlackRock has the following note. In our latest Markets Insight commentary, we argue that Rather than make bold predictions today, investors would be better served by focusing on probability weighted if then decisions while awaiting more data. It's quite easy to paint a apocalyptic picture of the global economy these days as just one example of many. If the war in Europe were to escalate, even greater commodity inflation could ensue. And if China were to continue to pursue a zero COVID policy amidst rising case counts, supply chains could remain shut. Yet all the ifs have reasonable odds of going the other way to create a more benign outcome. But until we have more details on financial conditions tightening relative to monetary policy, we think we should be patient. And so in general, that's why our portfolios are so balanced with deflationary and inflationary assets. And I'm going to go ahead and skip through that. He goes on for quite a while. Meanwhile, Japan is printing money aggressively alongside China. Japan does not want interest rates to rise in their bond market and are willing to print an unlimited amount of money. And so what we're now seeing is the Japanese currency fall. This is perhaps the most important story developing that's not being discussed widely. Some footage out of Europe. The Twitter drama is fun to watch, keeping close on that with Elon. Here's some footage out of China. Now we got to realize whatever's coming out of China is most likely propaganda being released on purpose. We learned our lesson not to trust what we see out of China from 2020. So one must ask, why are they behaving this way? There's millions of people starving in China now. The last thing a communist regime wants is to piss off the majority of the population. So this is a very, very risky move. There's supposed videos of them saying that we're at war with the US, and that's what this is all about. So very, very interesting. I don't have a clear idea of exactly why they're going into such extreme lockdowns. Here's a big thread about how we could potentially be in a bear market. And so far, the data is not supporting that. We'll look at that data in a moment. Here's the flagship Moskva going down. So this was a very important pivot in the whole storyline that has turned into an escalation in the war. Here's how long inflation's been over 2.5% since 1948. So in general, it doesn't go above 2.5 very often. And if it does, it doesn't last for very long. The longest period was from 1968 to 1980. And that's where we had a bear market in bonds and stocks. You got a great return in gold. And Mr. Volcker had to hike interest rates all the way up to 18%. So are we really heading into a decade of inflation, or is this going to be temporary? That's the most important question for financial markets. Amazon CEO, we're about 1% of the worldwide retail market segment, and 85% of retail still lives offline. So we're so early in all these areas. So it just gives you a feel, you know, if Amazon has become the just giant company it is today, and it's taken several decades to get there, and they still only have 1% of the retail market, it puts things into perspective for how big something like Ethereum could go, and makes you not worry that it's already up 20,000%, especially when you realize Bitcoin's up 1,000,000%. Bitcoin is coming off the exchanges. Everyone's afraid of confiscation. This is helping grow the DeFi, which we're a proponent in with our private equity offering. Putin's been saying he will only allow natural gas and oil to be sold in the ruble. And so far, most countries are not saying they will agree to that because it breaks sanctions. So that could be another catalyst to make natural gas go skyrocketing. But the ruble has gone back to its pre-war valuation. So far, the economy of Russia is trucking along with its energy exports, fueling the war. There will be a surge of containers from China when it resumes its economy, but no one knows when this will happen, how long it will take, and how backed up the domestic supply chains are. There's about 500 ships sitting on the ports on the shore now. For now, we know the freight market is slowing and China is only making things worse. The longer China goes offline, the more impactful to US supply chains, and this could impact domestic production and distribution. Inventories are at record highs, but this could burn off quickly. The bigger question is how screwed up China's domestic supply chain will be. Factories in China depend on upstream producers also in China. We also don't know the situation for raw materials coming into the country. Freight networks are bidirectional, meaning that the ships waiting off the coast have some raw materials that are used in factory production. How long will it take to offload and transport these raw materials? No one knows. And since China is opaque, we don't have good data on the situation on the ground. The longer China remains in lockdown, the longer it will probably take to resume normal production cycles. That's a thread that it's basically discussing that the fact that Ukraine had the technology to take down this warship is evidence that Russia needed to make this move to protect itself against expansion from NATO, and why they did it. There's the missile that supposedly did it. A big thread about how it was pulled off. Very interesting story. If you want to watch it, follow our Twitter feed and you can get a lot more of the details. I really pick out the highlights for the live webinar. Here's an interesting credit card coming out where you can fund it with Bitcoin and not do KYC. So interesting development there. Alex Gladstein says there's a wild new IMF paper. That's the International Monetary Fund. The electronic money standard outlines a financial future where citizens cannot save because CBDCs with deep negative interest rates allow central bankers to overcome the zero lower bound. Okay, so we were talking about how for debt to grow, interest rates must go lower, but we're approaching 0%. So there's a lot of debate about how can they grow debt now at $300 trillion globally beyond that 0% bound. And so he says, so grateful the world has a plan B. We're about to jump into their plan. Breaking the zero lower bound, the IMF writes, requires eliminating the arbitrage opportunity between cash that guarantees a zero nominal interest rate and money in the bank that would earn negative interest rates if policy rates were cut into negative territory. So they're saying they want to basically make you lose your money if you don't spend it with central digital dollars that could easily be controlled in such a fashion. Much as during the Great Depression, when countries were able to revive their economies by going off the gold standard, moving from a paper standard to an electric money standard can empower monetary policy to cut interest rates as much as needed for economic stimulus. A zero lower bound can be broken through a combination of adopting, strengthening an electric money standard in which electronic money is the unit of account and implementing a time-varying interest rate, or more generally, rate of return on paper currency cash. Then, as interest rates on cash move in line with the official policy rates, there's no arbitrage between cash and money in the bank. Once the transition to the electronic standard eliminates the zero lower bound, A central bank can enable deep negative rates. It's important to read these papers to understand the mind of central bankers, dislocated from the individual human experience, trying to engineer society as if we were a big science experiment. Thankfully, citizens can opt out of this nonsense with Bitcoin. The biggest bond bubble in 800 years continues to deflate after rising. US inflation data. So we can see 6 trillion lost. Eggs are skyrocketing, everything's going up. Ukraine's asking for 50 billion in financial support and wants to issue bonds to fund it. Chris Martenson and I would say we were both a bit fooled by the footage from 2020. Definitely caught me betting in the wrong direction for too long. We shorted the March crash, but didn't switch gears quickly enough once we realized exactly how dangerous this really was, or not dangerous. So 2 years later, why do we have this coming out of China? Because everyone knows it's not that dangerous. So why? Very, very interesting. Here's a picture of the ship sitting out of China. So very, very interesting. Deflationary in that it's going to slow down China's economy and demand for imports. Inflationary for the US consumer, who's not going to be able to get their goods and services. And so we can see in the red line, the waiting time to load out of Shanghai has skyrocketed up. Lynn Alden says for decades, people didn't have the capability to send significant amounts of money globally without using banks. Governments can easily regulate banks. Technology has now provided consumer-to-consumer global payments. It will be interesting to see how governments respond. And the technology is open source too. Basically, if governments want to prevent it, they now have to do so on the consumer layer rather than merely the banking layer. The number of enforcement points to do that is many orders of magnitude larger the whole population. This is further complicated by the fact that other than stablecoins, cryptocurrencies aren't directly linked to currency. So if you send Bitcoin to someone, you are participating in an open source public ledger that officially isn't currency. It's just information or speech. Bitcoin and many cryptocurrencies are basically just a sophisticated way of people updating a big decentralized Google spreadsheet with each other. To prevent that from happening is challenging from a legal perspective outside of authoritarian regimes. Encryption and software have a legal precedent in several developed countries of being considered speech. Code is language. That obviously gets messier now that encryption and software can be used as a form of liquid bearer asset recognized money. Kyle Bass, who I think has exposure to oil because he's all pro-war with Ukraine, which surprises me. Another take on China's shutdown of Shanghai, Shenzhen, Guangdong, etc. China is desperately in need of crude oil, natural gas, food, basic materials, base metals, and more. Putin's invasion/massacre has created additional energy scarcity, inflation, and skyrocketing food inflation. Whilst China hasn't had any material problems with the virus from Wuhan in the past, it's interesting that their draconian lockdowns, in conjunction with telegraphing the purchase of fewer cargoes of natural gas and crude, are forcing global economists to ratchet growth expectations. Now, with that said, even with Biden's SPR release and China's lockdown, we still have oil above 110 and natural gas going through the roof currently. So this is pretty impressive commodity pressure currently. This is forcing economists to lower whilst currently shifting future demand projections for commodities lower. Everything China desperately needs to acquire is trading down in price as a result of the lockdowns. If we all take a look back, the primary driver of China's current account moving into negative territory happened to be the Chinese citizens traveling and spending abroad. They could only spend dollars, euros, and yen. The virus abruptly halted Chinese travel, gave the CPC supreme censorship power. Chinese travelers no longer open to uncensored internet, and allowed a crushing takeover of Hong Kong without further incident. The virus appeared at the zenith of the Hong Kong protests. Either the occurrences of the virus are perfectly coincidental and incredibly helpful to the CPC's existential crisis, or a much more insidious modus operandi is at work. Remember, rampant food price inflation was one key grievance that led to the Tiananmen Square protest massacre, as well as the Arab Spring. It's too late for Xi and the world to avoid food price spike, as it will certainly worsen next year given input pricing. Economic slowdown projecting will be pushed to Wall Street economists by the CPC on one hand, while positive speeches by the likes of Liu He are designed to keep Chinese stocks from resuming their free fall. Think about the LME nickel disaster. China's largest nickel trader, aka Big Shot, had and has the largest short position in nickel on the exchange. It's widely accepted that nickel is and will continue to be in a global deficit due to insatiable demand for nickel-rich batteries and EVs, and Russian production being removed from the market. Why would China's largest nickel producer and trader have such an enormous short position if he can't deliver into expiry? Is China manipulating nickel prices lower in an effort to keep a cap on them? China's HKEX bought the 152-year-old London Metal Exchange, LME, in 2012. The LME sale to a Chinese entity should have been blocked for obvious reasons. The trading halt, the cancellation of over $4 billion of trades, and the subsequent investigation into the buyers all smells like a corrupt investigation with Chinese characteristics. Remember, it was the giant short position of China's largest nickel trader producer that refused to pay margin calls, along with China Construction Bank. A comprehensive review of China's actions begins to look like a beautiful mosaic of controlled manipulation of global commodity markets. In the long run, I believe that will pay in spades to belong all the commodities China is insidiously manipulating lower. And again, that's one reason why I think he's so pro-war. He must be playing these commodities. 40% of China's GDP now in lockdown, according to Nomura Bank. Here's a look at commodity prices, rate of change relative to Chinese imports. So this is predicting potentially a drop in commodity prices ahead. Here's the natural gas storage at, I think, Gazprom at 0. Daniel Rubin says, well, what happens when China's demand does come back online and supply chains are not solved? $373 million people in 45 cities are now in full or partial lockdown. MSNBC says Elon Musk is trying to control how people think. That's our job. Board members effectively own none of Twitter. Okay, so I think that really catches us up with what's going on. And here's a look at all the bond markets. It's not just US. All of them have broken out of very critical levels. Okay, before we jump into the charts and tables and all that, let's take a look at the chat. We've got 70 live. Awesome.
Yeah, and Jason, Tom Frank, and you know it's weird. I got a bunch of people over the weekend that heard that Bitcoin's going to 0, or Tom typed in if it was going to 20,000. If you want to just take a minute on that, Jason, I think that would be helpful. That seemed to be a weird topic. A lot of people reached out to me, especially the 50 plus demographic that has a lot of wealth, were the people that reached out specifically.
Yeah, I don't see that happening. So we're seeing debt grow in the U.S. at a pretty good clip. You know, we're not at the 4 trillion per year, but we're running at least 1.5 trillion. We got Japan printing money aggressively. We have China printing money aggressively. Europe's going to have to raise probably several hundred billion to fix all the supply chains out of Europe. And we're now at the point where the banks and the central banks are most likely going to have to ease off all this hawkish rhetoric, otherwise risk collapsing the bond markets. So I find that highly unlikely that cryptocurrencies are going to zero or lower. Right? We're at a 50% pullback currently, and we're ahead of midterms. So my outlook is a extreme bull run for the next 2 years in cryptocurrencies. And if I'm wrong, we're hedged. So we're hedged in all the ways that would protect us against me being wrong with that, which is what's so beautiful about our strategies. We don't go all in on one play. You know, we're not all in on Boyle. To protect Boyle, we're long TMF. To protect the cryptocurrencies, we're long Boyle and we're long UVXY. So each position is designed to protect the other. But in general, the interest rates rising are our biggest fear. They've risen and Bitcoin is held strong. So to be at 40,000 with one of the worst bond crashes in history just shows you how bullish this asset is. And I'm going to tell you what's going to get you excited. Bitcoin has returned 1,000,000% with DXY going from that's the dollar, going from 72 to 100. The second this conflict is resolved and energy costs fall, we're going to expect DXY to fall. And that's when I'm expecting Bitcoin to go skyrocketing up, because the relative value of crypto against the dollar is going to be going in our favor. So the returns we racked up in 2021, primarily long crypto, the dollar rose from 89 to 96. Okay, so I just want you guys to get excited for a period of time where the dollar weakens. We're running massive twin deficits. Okay, so the long-term outlook for the dollar is going to be something more like this period from 2002 to 2008, falling dollar. Now the conflict in the very short term is driving demand for the dollar. In the long run, what's happening is all of Asia and Europe are rerouting trade to bypass the dollar. So what's happening is absolutely horrible for the US and its ability to have this super powerful dollar and bond market. So my expectation over the next 3 to 4 years is the dollar will fall and cryptocurrencies melt up to new highs. I know we've got a lot of crypto fans in there. So, but again, we're hedged. This year we've been making all the money for a little bit on UVXY and mostly on Boyle. But I think we're about to have the exact opposite. Bonds make money and cryptocurrencies make money. But yeah, that's a great question. Okay, so here's a look at bond market over 40 years. What comes after really sharp rises in interest rates? Very sharp declines, and very complex to understand that. But essentially the US will go insolvent if these rates don't go down. And all the politicians will lose their jobs and they'll stop being able to rob the Americans and hand it out to all their donors. So very, very, very unlikely these interest rates go any higher. I'd be shocked if they go at all higher from here. And again, another look at that very critical line in the sand was 120. Now, I did get one thing wrong on the prediction for TLT. If you guys have been following my webinars, I thought it would take 2 years to get the 120 TLT, and it would take 2 years for us to make the gains that coincide with the TLT falling. which was BOIL in NRGU. So we racked up 2 years of gains in about 3 months, just phenomenal. So now we need to flip. We need to flip. We're going to bet that interest rates are going to fall and that energy costs must come down. And I think we're probably going to see the peak prices in May. The free trial guest says, I'm confused. You're saying the Fed will not raise it. The bond market's already priced in the next 2 year rate hikes in a matter of 3 months. So as long as they just stay with what's priced in, the bond market's going to be very happy and you're going to see the TLT go up. So right now what's priced in are 50 basis point rate hikes and a $95 billion a month runoff of the balance sheet. And then there's going to be room for surprises. So if they were to come out and do 75 basis points and do, let's say, 200 billion a month of runoff, or they're going to say, you know what, we're going to target only selling long into the, something like that would shock the market. But what the Fed has been doing is hyping up a lot of talk about being very hawkish, and then coming up with Powell to the podium and saying, you know what, there's a lot of uncertainty out there. We're going to have to be a little easy with this and careful. And so they tend to deliver just a little bit less than what they've been hyping up and forecasting. But the bond market's priced in essentially 13 rate hikes over 2 years and a $95 billion a month runoff, that this will essentially lead to a recession in 2023 and drive them to lower interest rates. So the whole market is already front running all of this. So very, very fascinating how fast markets respond to data now and price in 2 years of implementation of the Fed into literally this just happened in 3 months to start out the year.
Way to nail that too, Jason.
Here's your mortgage rates. So again, look, the housing market is half of global debt is houses, $150 trillion. These interest rates have risen back to that 2018. So everything's at critical levels. It's extremely unlikely interest rates go any higher than here. So if you're looking for a surefire way to make money over the next few years, bet on bonds. And we made a ton of money in the March 2020 crash being very long the TLT. We didn't sell perfectly because we still made a lot of money on it. We didn't sell perfectly because the bond market started to crash with the stock market, which was unheard of and really what freaked the Fed out into going so aggressive. But we were smart to get out of bonds at that time and never go back until literally last week or April, what was it, 6th. So we've took a 2-year break from being a bond bull, and now we're back. So far we have a small drawdown. I think we entered TLT at 125 or at 120. I absolutely do not see the TLT going below 120 for long, and if it does, it'll start to create a crash in other markets, which will drive yields lower or the TLT back up. Okay, so here's the infamous yield curve spread between the 2-year and the 10-year. A lot of people say you're better off with the 3-month and 10-year. The 3-month and 10-year is not showing an inverted yield curve, but this one has inverted and is starting to steepen. It's the steepening that leads to the crisis, and it usually takes 12 to 16 months. So if the long end were to rise as the 2-year were to fall, that would create this pattern that has predicted crashes. But the lead up is very bullish in markets. Half of all debt globally is the housing market, Stephen. 150, it's the biggest market of all. All right, here's another way to look at the yield curve. So we've got the 20-year over the 30-year, which is funny. We used to have the 2, 3, and 5, and 7 over the 10-year, but that is fixed. So not a pretty yield curve. We're carefully monitoring it. But in general, inverted yield curve leads to a bullish setup for about 12 to 24 months. And it's the steepening of the yield curve that can cause problems. Probability is to go up 50 basis points in the May meeting and again begin the roll off of 95 billion a month. Now the market may like a slowly tightening Fed because it's going to make the expectation that they're going to calm down inflation. So I'm not too concerned. I believe everything that is priced into the bond market will be happy with what happens in May and most likely drive these yields lower. Here's the VIX. This is what we play with UVXY. We're mostly interested where the biggest jumps in the dots are. So April to May, May to June. And again, we have these energy uncertainties. We have the China supply chain issues. And then we have the Fed hiking rates. So we can see the greatest premium for hedging is in the next 2 months. Reverse repo still at $1.7 trillion. This money is just stuck in there and won't come out. When it does, could be a very bullish moment for stocks and potentially a warning sign for bonds. But at this point, I'm not too worried about bonds going any higher in interest rates. This chart we call the Dr. Copper. It's comparing copper to gold. If gold's going up faster than copper, it's predicting lower rates. If copper's going up faster than gold, it's predicting higher rates. At this point, they're trading evenly. So no prediction from Dr. Copper on this short-term data. If we zoom out a tiny bit, we're seeing gold is starting to outperform copper. And again, this would be predictive of lower interest rates. Now, of course, with China shutting down, that will drive the demand for copper lower and put you in this stagflation type of environment. Also, furthermore, with the US essentially freezing trillions of foreign money, this is also driving people to alternative ways to store value, which is gold. Okay, here's our Boyle NRGU chart. For a little while, people were pretty upset with me for switching out of NRGU to Boyle. But today, Boyle from the trade alert, Boyle's up 270% and NRGU is only up 196%. So go Boyle, go. Again, I do anticipate selling half that position. It's nerve-wracking how high it's gone up. And unfortunately, I do see it going higher from here. So if you're wondering if you should still get in, yes, I most likely will start to take some more profits as the returns are very extreme for us at this point. Okay, lumber futures against oil. Can we predict demand for oil ahead of time by looking at lumber futures? Maybe. Last year it worked and we ignored it, unfortunately. We basically held NRGU through the pullback in the summer with a high conviction that as the economies went online, oil demand would go up. And the slowdown in the summer, I did not predict, even though lumber futures were crashing. But we held through it and ended off paying big time. But now we got lumber futures giving us another warning sign. So I'm pretty tempted to slowly get out of Boyle and then look for a dip in energy to go long again. And if China wants to keep locked down, that will help make this happen. Okay, here's dollar. So crypto is going to explode higher with the dollar falling. Okay, so you've been facing a rising dollar being a crypto investor for 12 years. And if you bought it at the start, you're up 1,000,000%, or maybe it's 3,000,000%. It's just an insane return. So for you crypto fans out there, get ready for a weak dollar. And that's when you're going to have some extreme profits. And I think we're on the very verge of a weak dollar for the next 3 to 4 years. China's currency, we're watching for a devaluation via printing money. So far, not happening. In this chart, we're comparing Bitcoin down 29% over this time frame, Ethereum up 70%, and then Polygon up 236%. So in our safe growth strategy, we're keeping it simple with the largest market cap crypto for one of our bigger positions, Bitcoin, GBTC. In our high risk portfolio, we're long Ethereum with ETHE. For our private equity, which is only available to paid portfolio builder members, We've got about, for every dollar we have in Ethereum, we have about 50 cents in Polygon, which is Matic. And so you can see this one can really fly. So if you know what the Lightning Network is for Bitcoin, then you'll understand what Polygon does for Ethereum. It's absolutely critical to its success long term. Now, it looks like the merge for Ethereum has been delayed, unfortunately, which is going to switch it over to proof of stake. But better to do it right than to come out with a buggy product. The setup for Polygon is looking beautiful and could very likely triple from here. We don't have Polygon in our portfolio builder products, but if you're interested and you're a paid member, you want to get into Rebel dividends, call Dean. And that's the only position I really like in crypto that we don't have with portfolio builder. I'm starting to look at silver as a way to normalize returns for the high risk strategy. And the risk of a stagflation period coming up, especially if China wants to stay in COVID zero for God knows how long. Also, we're going to see the Democrats push for more lockdowns and mail-in voting ahead of midterms. Who knows? But we've been seeing somewhat of the opposite return on silver versus Ethereum. And potentially that could help us have a smoother return, maybe not a higher return, but less volatility, which is always nice. So carefully monitoring that. And I'm not certain we'll pull the trigger on it just because there's 10 million jobs and there's only 5 million workers. So I'm still seeing strong labor growth, strong economy. I'm not seeing necessarily a stagflation environment coming ahead. Look at that data. But we are seeing the rest of the world realizing dollars are not the best reserve if they're going to be taken away, and perhaps you should be backing your currency with gold and thus silver as an alternative or commodities. This chart really sums up the whole strategy in one picture. In yellow are interest rates. Green we call value or commodities, NRGU, and in the below we have growth, the NASDAQ. In general, if interest rates go up, we like the value sector of the market or commodities. If interest rates are going to fall, we like tech companies, which benefit from lower interest rates in a lower growth environment. And so that's what we're expecting, is that the move in interest rates and commodities is greatly overdone. Will peak out probably in May and then fall. And most likely the catalyst will be Ukraine surrendering to Russia, is what I'm anticipating. Bill Burt says, I'm up 24 grand in BOIL in a week, or well, I don't know how long. Very good. Okay, so if the dollar is going to fall and China is going to kick some ass over the next decade relative to the US, US is going to be having to reduce debt, have tighter monetary policy, fighting inflation to get it down. Potentially gridlock government with the House and Senate potentially flipping to the Republicans. And China is going to go into a printing spree and try to take the lead economically this decade. Should we be long emerging markets? And I believe yes. Here's the chart to get you excited over a period of a weaker dollar. So when we had a weaker dollar, 2002 to 2008, emerging markets went up 400%. When the US SPY only went up 80%. So in our safe growth strategy, we're playing that. In the high risk strategy, we'd be getting some exposure to this by going long FNGU. But again, only 2 out of the 12 companies in FNGU are Chinese. But I like it because it's leveraged and we're believing that interest rates are going to fall and that growth stocks are going to go up in value in the near term. There's Alibaba getting the wind knocked out of it again, down 14%. I guess Charlie Munger sold some or all of his position, Tencent down 5%. So the Chinese are back in lockdown. These Chinese have been doing crazy things for over a year now. So very, very interesting. Here's EFO. This is our other position in the safe growth strategy, playing Europe plus Japan. And so it got hit from the war, but has nearly regained a lot of those losses. And again, most likely this war is going to come to an end. There's too much pain on all sides. And I think we're going to see a lot of debt and money printing. So very bullish for that stock market as well. Now here's the alternative energy plays that were long in the safe growth strategy. Rare earth metals, REMX, this is going to be a great play for decades to come. There's just not enough lithium and cobalt to grow Tesla and Apple, just to make it real simple. Those companies are going to be buying the raw materials that REMX provides, and they're most likely going to have extreme shortages in the coming 3 years. I like rare earth metals better than copper miners, very correlated, as you can tell. The uranium play we're still in, and that is URA. So that's for nuclear power. So again, two alternatives to the ugly energy products, natural gas and oil. Here's the gold silver ratio. Anytime we get a big gap, potentially an opportunity there. In the crypto space, we always see Bitcoin go up, then Ethereum, and then the altcoins. So you can wait for the big one to make the move first, and then jump into the little one for a safer gain. And that's pretty much what I'm sitting here watching this chart for. This was what we were hoping for, but better than what I expected. So I was hoping the core inflation rate would be below 7, and that this would be peak inflation, and that we would fall from here. And that's critical for how we're currently positioned. If this goes higher in the coming months and doesn't start to fall, there's big problems ahead. You're going to have a 70s like fiasco where you crash bonds and stocks and something like gold goes up. And the Fed's going to have to hike interest rates way higher than we're anticipating. So this print is lower than I expected and exactly what we wanted. So as soon as the food and energy costs start to cool down and supply chains are fixed, we should expect this to fall. So with that said, there seems to be no end in sight with the war, and China is acting very funny, destructing the supply chains. How long will this go on? So at this point, I think we'll see both resolved by hopefully May. If it's not resolved by June, we may start to take a different look at how to play the markets. Okay, jobs keep piling in. Labor force participation continues to rise. Bank credit's growing. Consumer credit's growing. Retail sales are growing. Retail gross sales hit a record. The trade deficit continues to grow. New home sales continue to grow despite these high mortgage rates. So all of that's exactly what we want to see to remain long stocks. Meanwhile, China's PMI has fallen below 50. They're printing money aggressively. Japan is already doing yield curve control. Europe's likely going to have to be very dovish to fund everything happening in the European conflict. Now you can see there's that big drop in exports and imports out of China. So that is likely going to drive yields lower and cause them to print more money. If these continue to crash, though, we might be able to predict a weak US consumer before it starts to hit the data. And again, that would cause us to like bonds and the VIX and not like stocks. Okay, so here's a look at the Federal Reserve's balance sheet. This is going to start falling by $95 billion a month, supposedly in May, and they're going to hike interest rates 50 basis points. So we're going to be carefully monitoring how the markets respond to that. But so far, I think this is all priced in already. And meanwhile, the central banks in the Euro area continue to print at rapid pace. Okay, very good. So this is where your video ends if you're not a paid member. We're about to reveal the exact positions and show you the membership area where you can punch in how much money you want to invest. and it will tell you exactly how many shares to buy of each asset. So don't miss the next trade alert. Call Dean now at 505-322-7515.